This is a $100 bill. It's just a piece of paper. The value, however, is based on the full faith and credit of the United States government. It varies according to different economic factors, like the monetary policies of the Federal Reserve Bank. For example, if the Fed resorts to policies that increase the supply of money, the dollar value can decrease in comparison to other currencies around the world. This is possible because the dollar is a fiat money, which means it is not backed by any tangible commodity. But it was not always like this. For some time, the value of the dollar was pegged to gold in what economists call the gold standard monetary system. This system was abandoned in 1973, but the idea still survives among enthusiasts. But how would the economy be if we still had the gold standard? Would we be better or worse off? Let's take a look. Every once in a while, the gold standard goes back into fashion. The world has moved on from currencies attached to the precious metal for 50 years, but discussions around the topic are more vivid than ever. To understand why going back to the gold standard is still appealing to some people, we need to dive into what are the disadvantages and advantages of the system. The biggest argument pro-gold standard has to do with safety and stability. One can argue that gold retains a stable value to the currency, and this theoretically could reduce the risk of instability and economic crises. With a fixed asset backing the money's value, governments wouldn't be able to raise their debts without first buying more gold. For some people, especially those who worry about hyperinflation and do not trust governments or central banks, the gold standard is a great tool to legally curb government spending and the money supply into society. According to this thought, with the currency attached to limited physical assets like gold, the risks of debt spiraling out of control followed by inflationary periods are smaller, and long-term stability, safety and prosperity would follow. Supporters of the gold standard believe that the system does not allow the government to resort to expansionary measures as it seems fit. Or what critics usually say, simply print more money to finance new debt. And let's be honest, the US debt problem is getting bigger by the day. At the end of 2020, the US government debt held by the public was at more than $21 trillion, a little bit more than the whole GDP. As a comparison, that's much more than what the country owns in gold. The US gold reserves were valued at $11 trillion by the end of 2020. If we look at the historical graph of United States debt since 1966, we can clearly see a path. Look at it here. That's when the country left the gold standard. Now check what happened next. Some believe that if the United States continues down this path, the result will inevitably be a severe crisis in the years to come, and the solution for that might rest on going back to the gold standard. But for some, things are not as simple as gold standard defenders believe. No one disagrees that the US fiscal situation is challenging. But having the currency tied to gold would change some of the most basic fundamentals of the current monetary policy. In the ongoing system, the Federal Reserve can respond to financial crises in many ways. Among many measures, it can lower interest rates during a recession, raise the rates during an inflationary period, or it can buy or sell government bonds and inject money into the economy when necessary. And this flexibility to act according to the situation was very important in the last decade. During the 2008 financial crash or 2020 COVID crisis, the Fed has resorted to expansionary measures. In both cases, if the currency were still pegged to gold, the Fed's actions would be limited, and one can only imagine both the social and economic impacts that might have incurred. On the gold standard system, the focus of any monetary policy would be diverted away from ensuring economic stability to maintaining an exchange rate target. With gold being the most important aspect of the economy, the country's need to keep its reserves intact becomes the focal point of the central banks, more than providing an ideal business scenario, fighting unemployment, or raising productivity. Also, making exchange rate adjustments would be more difficult, and the government would have to resort to alternatives like protectionist measures, higher tariffs, import quotas, or exchange control. The results of this could harm economies around the world and affect global trade. Another negative aspect of the gold standard that is not very often discussed would be environmental damage. Gold is a scarce mineral. Increased demand for gold would mean that mining activity would also increase, very often on indigenous lands around the world. The impacts of this could be devastating. Okay, back to the question of how the economy would look like when we still have the dollar pegged to gold. 3 economists have a possible answer to this question. Through a quantitative method, they calculate how the US economy would have performed if the dollar was still pegged to the gold between 2000 and 2020. the results are not very good for the gold standard advocates. For example, the researchers found that the shocks on gold supply and demand would have a greater negative effect on the economy than any other shocks that have happened, such as an economic crisis. If the gold standard was still in place during this period, we would have an increase in economic volatilities and a deterioration of the household welfare. Basically, the speed at which gold is mined introduces a lot of randomness to monetary policy. The Fed would have to set interest rates to maintain a fixed dollar price of gold, rather than to target inflation as it is today. For example, in moments of crisis, people spend less and investors purchase more gold, a safe haven investment. In this case, the central bank would have to increase the interest rate to make other assets more attractive and control the price of the mineral. If the reverse happens and for some reason there is more gold in the world, the central bank would have to lower the interest rate. In the end, the monetary decision would not be rational or based on facts and estimations, but more a matter of faith, or a belief on what could happen to the gold situation in the world. In summary, an economy based on how much gold is mined around the world would be, let's say, probably more unstable. But is it even reasonable to consider a transition back to gold standard? Well, it depends who you ask. For some, it would be a big mess, but not impossible. For starters, the United States would not be able to go back to the gold standard alone. Due to trade and money supply, it would be very complicated for the US to do this alone. Otherwise, countries that own large chunks of US debt, like China, for example, could just ask for their dollars to be exchanged for gold. In theory, that would not be a problem, but, and that's a big but, if every debt holder does the same, the US probably won't have enough gold in its reserve to pay it all back. Yes, the numbers don't match. So, if it wants to go down this path, the US would have to pump its gold reserves, or the gold price would have to be set so high and the dollar would be so devalued that inflation would follow and trade would possibly crash. That's the scenario that critics of the gold standard believe to happen if an attempt to go back would take place. But defenders do not agree with that. In the end, the gold standard is not as unusual as some people want to believe. It's just a fixed-valued system. According to the IMF, many countries around the world have their currencies somehow linked to an external standard, typically the euro or the dollar. For a country going back to the gold standard would be more of the same and not that crazy. And if these views were once restricted to the fringes, it really made it to the mainstream in the last years. The Republican Party called for a commission to investigate the viability of going back to the gold standard on the campaign platforms of 2012 and 2016. A bill to establish a commission to look into the feasibility of the gold standard was approved in the House of Representatives in 2015 and 2017, but never managed to get approved in the Senate. Alexander Mooney, a representative from West Virginia, even proposed the full-on return to the gold standard on a bill that never got co-sponsors and never happened. In 2020, when then-President Donald Trump appointed Judy Shelton, a longtime gold standard advocate, to a seat on the Federal Reserve's Board of Governors, everyone thought that Shelton would finally get to the front seat of monetary policymakers. The nomination got stuck in the Senate and never happened, but Shelton's ideas were put under the spotlight. In the past, she had called for a new Bretton Woods conference, referencing the 1944 meeting that established the post-war economic order. To understand exactly what a new Bretton Woods would mean today, we need to go back in time and look into the origins of the first one. The road to Bretton Woods was paved by policies and choices from way before the conference. In 1900, the Gold Standard Act made the policy official in the United States. The gold dollar was then declared the standard unit, and all forms of money issued by the government were to be maintained at parity with it. After the First World War, countries started experimenting, leaving the gold standard and printing more money to save their economies. The United States kept the gold standard. After the crash of '29, investors started trading commodities and currencies looking for safer investments, and the price of gold rose. A hoarding phenomenon spread in the United States, affecting the country's gold reserves. In 1933, U.S. President Franklin Delano Roosevelt issued an executive order forbidding hoarding, and the Gold Reserve Act was signed in 1934. With the forbidding, people were allowed to keep just the equivalent of $100 and everything else needed to be returned to the state. The Gold Reserve Act would lead to the creation of the reserves at Fort Knox in 1936, the legendary U.S. gold depository in Kentucky, where 143 million ounces of gold are kept at the moment. Fast forward to the last year of the Second World War. Representatives of 44 countries gathered in July 1944 in Bretton Woods, a resort place in New Hampshire, to organize what would be the post-war monetary system. It was also in the same event that the ideas of the International Monetary Fund and the World Bank, initially focused only on reconstruction, were forged. The Americans arrived at Bretton Woods in a very strong position. With reserves of 20,000 metric tons of gold, roughly 60% of the world's total, they advocated for fixed conversion rates assured by a dollar tied to gold. The Brits, heavily in debt and broke after the war, were hoping for flexible exchange rates to revive exports. But the Americans feared post-war inflation. In the end, the Americans had their way. After the agreement, the countries were to keep their currencies fixed, but adjustable to the dollar, which was pegged to gold at 35 an ounce. It was only by 1959, however, that the system started operating as agreed in Bretton Woods. Up to this point, countries maintained fixed exchange rates in relation to the dollar by buying their currency in exchange markets when too low or increasing the supply of money when too high. During the 60s, a surplus of dollars caused by foreign aid, military spending due to the Vietnam War and foreign investment made it almost impossible for the United States to keep the value of the gold at 35. Presidents tried to control the gold price with actions like restrictions on foreign lending. This resulted in the nation's foreign trading position being damaged for the overvalued dollar. In 1971, then-President Richard Nixon announced that the United States would no longer buy gold to maintain the price at $35 and halted the convertibility, which meant that countries could no longer redeem dollars for gold. 2 years later, the gold standard was scrapped altogether. The members of the European community tied their currencies together and jointly floated against the US dollar. This marked the end of the Bretton Woods Agreement. With Sheldon far from the Fed's Board of Governors, a second edition of Bretton Woods might not happen anytime soon. But the idea of going back to gold standard is still around and will not go away. So that's it for this video. What if the dollar was still pegged to the gold? We hope you like to learn more about the relation between gold and the monetary system. Since you made it to the end, click around and watch more. We hope you liked our video and subscribe to our channel.